In this video, I want to go over a way that investors can make money while they wait for a stock to hit their target buy price. Because yes, you can make money while you wait with a little something called a stock option. I'll go over the basics of how options work, and then I'll show how a value investor in particular can produce some extra income for their portfolio while they wait for a stock to hit a particular price. Let's get into it. An option is a contract, and that contract gives you the right, but not the obligation, to buy or sell a stock at a particular price before a particular time. Now, options come in two flavors: call options and put options, and which one you buy typically depends on which direction you think the stock is going to be going. And your typical option contract will give you the right to buy or sell 100 shares at a particular strike price. And the strike price is the price of the option where you can exercise that particular option. For example, let's say you have a stock trading at $100 and you buy a call option at a strike price of $110. And we'll say the option expires in 3 months. This means that you have the right, but not the obligation, to buy 100 shares of that stock at $110 before the expiration date. But the stock's only trading at $100 right now, so it wouldn't make sense to exercise it. But let's say the stock moves up to $115 per share, but you still have that right to be able to buy it at only $110 per share. Now you can exercise that option at $110 per share and immediately sell those shares at $115 per share if you wanted to. It's an instant profit in that case. But of course, to buy the contract, to buy the option in the first place, you have to pay some money, and that's the option premium. So in just about every case, the actual break-even price, if you were to exercise an option, would be over the actual strike price of that option. So in this case, the actual break-even price would be over $110 per share. Now that example was a call option. What about a put option? Well, the mechanics are very similar, but it's in the opposite direction. When you buy a put option, you're buying the right, but not the obligation, to sell a stock at a particular price before a particular date. So let's say you have the same stock that's trading for $100. You buy a put option to sell 100 shares of that stock at $90 sometime in the future. If the stock were to drop to $85 per share before that option expired, you'd have the right to sell that stock at $90, even though it's only trading for $85 per share. So in that way, you're actually able to make money as the share price falls. But both of these examples were long options in that you bought the contracts and then you waited them out. You never had the obligation to actually exercise these options. But what about selling, or as it's called, writing an option? Let's get into that. In the previous examples, that was buying an option. You buy the right to buy or sell a stock at a particular price. That's it. And the risk when you buy an option is capped at the actual investment you made into that option. And as time goes on, the option will face time decay, so it's losing value as there's less and less time for the stock to move before the option actually expires. But the opposite is true for writing or selling an option. When you write an option, you give someone else the right to buy or sell a stock at a particular price before a particular day. This means that you're basically the insurance provider for that particular options contract. If someone wants to exercise that option that you sold to them, you're going to have to bring the collateral, whether that be the actual shares or the cash to buy those shares. But when you sell an options contract, you get the premium up front. You're collecting the actual value of that contract right away. And as time goes on, the time value of that option will decay. And then if you want to close it later on, after a bunch of time decay has already occurred, and assuming the stock hasn't hit the option strike price or anything like that, then you can actually close out that option by essentially buying it back at a lower price. So the difference between your initial premium and the closing price would be your profit if you were to trade an option that way. But when you write an option, there's a risk of being assigned. This is where you're forced to sell or buy the stock at a particular price. Now, when you write an option, you're exposed to what's called assignment risk. This means that if the stock hits the strike price on the contract that you wrote, then the person who holds that contract can assign it against you, meaning that you're going to have to provide the collateral for that contract. So that might be selling your shares if you've written a call option and it hits that strike price, or it might be buying shares if you wrote a put option, in which case you'd be forced to buy it at whatever that strike price is. And this is where stock options can be a super useful tool for a value investor who has some cash on the sidelines, but we'll get back to that in just a second. But first, we actually have to figure out how to value a stock. Now, if you're in the value investing camp, and when I say value investing, I'm really referring to the approach that someone like a Warren Buffett might take, where you're trying to buy a stock below what you call its intrinsic value. And the general premise here is that every stock is a share of a business, and the business itself has some sort of intrinsic value. The question is, how do you actually value that business? And after you value that business, you can compare it to the current share price and figure out whether or not it's a good deal to go ahead and buy. The key distinction here is between intrinsic value and price. They're not always the same thing, at least from a value investing investor's perspective. Or to quote Warren Buffett, price is what you pay, value is what you get. And there are lots of different ways to potentially value a business. In many cases, something like a discounted cash flow model is a popular option. It's something that I use quite a bit. You can also look at things from a liquidation value, where you try to see what the value of all the assets in the business are worth compared to their liabilities, and then see if that difference is actually more or less than the market cap. And valuing a business can definitely be more of an art than a science sometimes, but the point is you can try to assign some sort of intrinsic value to the stock and see how much that differs from the actual price. And then you can make your decision from there. So maybe you think a business is worth $100 per share, but it's currently trading for $120 per share. So you wouldn't make that investment because you think it's overvalued. So you're just sitting there waiting for the stock price to fall, and you have your cash in your portfolio that's really just sitting there doing nothing. This is where options can come in. So sticking with our current example, we have a $120 per share stock that you think is intrinsically worth $100 per share. And in this case, you decide you want to buy it at that $100 mark, you're ready to deploy your cash, but the stock simply isn't at that price. Now, because you already have some cash in your account that can be used as collateral, you go ahead and write a put option for the stock at $100 strike price. This means you're giving someone the right to sell you 100 shares of that stock at $100 per share. And we'll say the expiration date is a few months in the future. Well, look what happens when you sell that option. All of a sudden, you get to collect the premium from actually selling that options contract while you wait for the stock to fall in price. So you're actually getting this money up front as income. And if the stock price does fall below the $100 strike price, you'll be assigned to actually buy those shares at the $100 per share strike price. But you're okay with that because you actually wanted to buy the stock at that strike price. But meanwhile, you still got to collect that options premium at the beginning. But what if the stock never falls down to that $100 strike price before the expiration date? Well, you still get to keep that premium, and it's as though you just made some extra income on the cash in your portfolio without actually having put it into a stock. So in that way, writing options is a way for you to make some extra money while you wait for a stock to hit a particular price that you'd actually be willing to buy it at. And you can actually do the same on the opposite end by selling what's called a covered call. Let's say you own 100 shares of a particular stock and you're willing to sell it only when it gets above a particular strike price. Well, you can write a call option against your 100 shares saying that you'd be willing to sell it at that strike price before some particular date. And the mechanics are very similar. In the event that the stock doesn't hit that strike price, you still get to keep the options premium. And if it does hit that strike price, you still keep the options premium that you got at the beginning. Only in this case, you'd also have to sell your stock at that strike price, so you would lose out on any potential gains after that. But that was the price you wanted to sell at anyways, so is it really a loss? And this brings me to the main risk of this sort of strategy, and that's really opportunity cost. When you're writing options, you have to lock up some sort of collateral at some point. When you're selling puts, you're going to have some sort of cash or even margin if you like to live dangerously, in that you're going to need to have money ready to go if it hits that strike price. So your brokerage will probably lock up that cash for you. And of course, once you're assigned, there's a chance that the stock goes below your strike price, so you might not be getting the greatest deal on the stock on that particular day that it's assigned. And the same goes for a covered call. In the event that a stock shoots way past your actual strike price, you might be missing out on some potential profits if you were to have held it and then sold it at the top. And there's always a chance that the fundamentals of the company can actually change before your expiration date, in which case you might not even like the strike price that you have on that options contract anymore. And if you want to close out that options contract, there's a chance that the price might have changed significantly and you might have to actually bring more money to the table to close it out. But like I said, in general, the biggest risk is going to be the opportunity cost of locking up the collateral, whether it be the shares or the cash that you need to buy the shares. But whatever the case, writing options can be a very powerful way to produce some extra income on top of the existing portfolio, especially if you have a lot of cash or if you have stocks that you have a particular sell price for and you want to do something like covered calls. That's why writing options can often make a lot of sense for someone like a value investor. Conclusion, stock options are a very powerful tool, but they can get confusing pretty quickly. So really be sure to do your research to make sure you actually know what you're doing. Talk with a licensed professional if you're still confused, but do realize that they are an option, and an especially viable option for someone like a value investor who assigns a particular intrinsic value to a stock and you're trying to get it at that particular price. Something like selling puts can be a great strategy. Or if there's a price that you know you want to sell it at, then you could do something like selling a covered call or writing a covered call option. That way you're producing extra income for your portfolio while you wait for whatever event you want to happen to actually happen. And there's always the risk of the opportunity cost of locking up the collateral for a particular trade, and also the risk that the underlying fundamentals in a business change, in which case your strike price might no longer be what you actually want to use. Whatever the case, tread carefully. Ideally, this was a decent primer on options and how a value investor in particular can use options to his or her advantage. Definitely let me know in the comments below if you're using this sort of strategy with options or some other strategy I didn't discuss, because there are lots of different ways you can do some pretty wild things with options. But anyways, if you like this video, please like it since that would help the channel out a lot, and be sure to subscribe since I put out new videos every single week and wouldn't want you guys to miss out. But until next time, take care.